Hello, everybody. Welcome to this webinar that is brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia. Today, our webinar is titled Tricky Hunt for Sunken Stocks. So, welcome to this webinar. Today, we have the head of research from Kenanga Investment Bank who will present on this topic. So, if you're ready for this session, maybe you can type ready in the chat box and let us know if you're ready for this session. All right, cool. I think all of you here are ready. So we're gonna gain the outlook for 2022. So we're gonna hear from the head of research from Kenanga Investment Bank about the outlook for 2022. So before we begin, as usual, disclaimers, whatever we share on this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy and sell. So you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker for this webinar. A veteran in the Malaysian capital market, Mr. Koh Huat Soon joined Kenanga Investment Bank as head of research after 19 years in senior management capacity in the fund management industry, where he held the position of chief investment officer. Prior to his fund management experience, he was an investment analyst with various sell-side research establishments, which include SG Research, RHB Research, Ong & Co, and CLSA. So Mr. Koh holds a Master of Business Administration from Melbourne University, Australia, and a Bachelor's of Arts degree from Oxford University, England. As head of research, Mr. Koh is responsible for formulating market strategy through carefully considered and timely analysis of macroeconomic and equity market conditions. So without further ado, let me hand over the floor to Mr. Koh. Mr. Koh, how are you?
Yeah, I'm fine. Thank you, Shane. Thank you.
All right, awesome. So I will just let you to share your screen. Then we are all good to go.
Okay, give me a second, yeah. Okay. Now I need to blow up the
screen. That's right.
Screen. Give me a second.
Go to the presentation mode.
Okay.
So this is the last session for CanTrade webinar in 2021. So appreciate it when all of you here can take out your precious time to join this session.
Excuse me, I'm having a little bit of a problem getting the
technical challenge, is it?
Okay, never mind. I'll tell you what. Give me a second.
Yes.
From
beginning.
From beginning, yeah.
Yeah, that's right.
All right, thank you, Shane. Thank you for that introduction and a warm welcome. And hello to everybody. Thank you all for making the time to listen in on this webinar. And I hope to spend the next 50 minutes to an hour to share with you Kenanga research view on what to expect for the market, the Malaysian stock market for 2022. Yeah. So let's dive straight into it. Okay. The third quarter 2021's result season has it's just over, and we've reviewed the earnings expectations for the full year. We've got one more quarter to go before the year is over, and so far, what we're expecting in terms of full year 2021 EPS for the KLCI is 108.6 cents. Now that's about 40% increase from the EPS of 2020, which was 75.5. And going into 2022, which is next year, we see a dip of about 8% from 2021 to 99.8 cents, and that's largely on account of the application of the prosperity tax. As we all know, during budget 2022, the government announced the prosperity tax that will be applied to earnings, net profit, or rather taxable income over 100 million ringgit. The application of 33% will be applied to chargeable income above 100 million. So it's going to impact especially the large companies with huge earnings, right? So therefore, the biggest companies that will be impacted by this ruling would be the KLCI components. So, and then going forward to 2023, we're expecting a kind of a resumption in growth momentum to 111 cents per share. So, in a nutshell, the 3-year EPS growth for the CI in terms of annual compounded rate would be about 13.7%, which is not bad. And what's leading this recovery would be firstly the banks, of course, because the banks, by the sheer weight of its presence in the index, banks account for about 36% of the index weight, and they are growing at around about 12% for the year 2021 over 2020. So that accounts for much of the upside. And then we also have plantations, which is about 9.8% weight in the CI. Now, plantations have had a very good year this year because of a very strong CPO price. In the second half of the year, we saw CPO price hovering at about 5,000 ringgit per ton, which is far better than what it used to be in 2020, which was hovering between 2,500 to 3,000. So that accounts for the those two were actually the main reasons why this bounce is happening for 2021. And for the first half of this year, we had supernormal profits enjoyed by the glove companies, but that's actually receding very quickly. So those are the three main factors that's driving earnings growth for 2021. Now, if you look at the...
Mr. Koh, there's this item pop up on the screen that asks you, please move these windows away. Okay, now I think it dissipated. Do you see a message?
Oh, yes, I do
out?
see that. Yeah.
Yeah. Something has happened in your laptop. And would also appreciate you can speak a bit louder.
Yeah. I'm sorry, I'm not sure how to remove this label here, which is, I know it's very annoying. Can I reload it? Can I stop sharing and try and redo it again?
Yeah, sure, please.
You don't mind, yeah?
Yeah, no worries.
Oh dear.
Yeah, apologies for the technical glitch, yeah? So be patient for a bit. We'll be right back.
Is this better?
Yes, now, yeah, we're back.
Okay.
At
Yeah,
least
sorry
the
about that.
message didn't pop up.
Okay, let me continue. Yeah, if you look at the returns, right, by sectors since the end of 2019, which was the pre-COVID endpoint, you realize that the number of sectors that generated positive returns over the last 2 years have been very narrow. There have been only 4 sectors out of 13 that has generated positive return over the last 2 years from sort of the pre-pandemic levels. Those 4 sectors are technology, healthcare, industrial products, and transport, while all the other 9 sectors have generated negative returns, with the worst being energy, which is oil and gas, and construction. Now, technology sector has been undergoing a kind of a circular growth because of the development of new technologies such as 5G, as well as electrical vehicles, which has a lot of semiconductor content, and as well as also with the pandemic and the lockdowns that's been imposed globally, there was a proliferation of working from home, which demanded greater use of smart devices, laptops, and so forth, which translated to greater use of data center facilities, and all that created demand for semiconductors, right? But beyond the pandemic, there's actually a circular growth story that's going to drive the technology further down the road. So not surprised why technology has done so well. We think that it could continue. Healthcare was a bit of a sort of a one-year wonder. It was really on the back of 2020 and the first half of 2021. Because of the pandemic, there was a huge surge in demand for gloves and PPEs because of protection against the virus, especially amongst the healthcare workers. But that's waning. Industrial product in this segment, right? You'll find that present in this sector would be a lot of the commodity-based players. For example, press metal have enjoyed a run in high aluminum price. Then there's also Malaysian smelting, which enjoyed the higher price of tin. And then also we had the petrochemical players as well, such as, petrochemicals have actually, prices have actually improved a lot this year. So which benefited the likes of Petronas Chemicals, Lotte Titan, and the like. So so industrial product was up because of that mainly, and as well as transport with warehousing facilities, and also the higher freight rates and so forth also helped some of these players there. But really, you look at the rest, like finance, for example, telecoms, consumer utility, property, plantations, which is probably a surprise because plantation did so well this year, and despite that, over a 2-year basis, it's still generating negative returns. REITs have been a big victim of the pandemic because of closure of malls for a period of time, and also much lower footfalls because of fear of contagion and things like that. Construction was affected by the lockdowns, and as was energy, oil and gas. And at one point in 2020, there was a big collapse in price of oil. So I suppose if you look at this chart, it gives you one can't help but question that, with the market, so many sectors down, is there actually value now in a lot of these plays, right? And that's the question that we're going to try and find an answer to as we go along. So I've highlighted the fact that over the last two years, if you measured over the last 2 years, there are a lot of sectors which are underwater. And if you look at Malaysia, how we perform as a stock market compared to our ASEAN peers, unfortunately, we are actually the worst performer this year so far. In US dollar terms, we are down nearly 11%. Singapore was up 6% in US dollar terms. Jakarta, nearly 7%. Thailand, down just 3% in US dollar terms, and Philippines down 5%. In local currency terms as well, all the other ASEAN peers charted positive returns this year. We were the only negative, return market with -8%. And if you look at the indices by size, KLCI was down about 9% price change. So the large caps were actually lagging in terms of performance compared to the small caps. Small caps was still down, but by just a bit, and the mid caps was down as well, but still less of a decline compared to the large caps. And I guess part of the reason is because you know, in 2020, especially, and early part of 2021, there was a lot of retail activity. There's a lot of liquidity in the market. And there was a rush to buy tech stocks, especially, and there are many tech stocks in the small cap space. And until recently, there was none of the tech companies were represented in the CI. But as of December, this month actually, one tech company did make it to the CI, which was Inari. So a lot of the small tech companies are actually in the small cap space. Okay, what about valuations? Right? If you look at KLCI, what PE is it trading on a 1 year forward basis? It's trading at a PE of 14.8 times on FY22, which is generating 99.8 cents. That's our expectation. Now, 14.8 times is below the 10-year mean. If you look at over the last 10 years, what is the average PE at which the CI is trading on a forward basis? It's 15.5 times. And today, it's trading at only 14.8 times on a 1 year forward basis. Now, if you look at expectations for FY23, your question would be, what's my expectations in terms of the KLCI target 1 year down the road? That means what is my guess on what the target will be at the end of 2022? So for that, I will base my calculation on what to expect in 2023. So in 2023, we're expecting the CI to generate an EPS of 111 cents. And based on the current level of about 14.90, is trading at a PE of only 13.4 times, right? Now, I'm going to apply a 14.9 times multiple, which I believe is a fair multiple at this stage of the cycle. So 14.9 times on 111 cents would give me a target of 1654. So my answer to you, if your question was, what is my expectations in terms of where the CI will land at the end of next year, it will be 1654. Of course, this target will be subjected to change throughout the course of the year, depending on the guidance of the corporates. As you know, each time they release results, normally we would have engagements with corporates and ask them about what they think lies ahead in terms of earnings prospects, right? So that's what we do as an analyst. We tweak our EPS expectations along the way. So right now, as far as the eye can see, we are saying that the likely target for the CI at the end of next year will be 1654. Now, what about this year? What's happened this year so far in terms of sector returns? Well, this is how it looks like. Again, there are only three sectors generated positive returns this year. Again, it's tech, industrial products, and transport. Now, amazingly, healthcare, which was the best performer in 2020, has relegated down to the worst. Healthcare, because of gloves, the collapse of glove stocks, right, meant that it pulled down the whole sector to negative minus 40%. So it's lost 40% of value, in the space of 12 months. The next worst was energy, oil and gas, which is quite strange, if you think about it, because since the second quarter of this year, we saw a recovery in price of Brent. Last year was quite unnerving because, just after the pandemic COVID started to become a pandemic, and basically, air travel just completely came to standstill, and people working from home. The demand for gasoline just plummeted, and oil price just fell, like just dropped, free falling. But early this year we saw that turning around, and today just not long ago, Brent hit a high of $80 to $85 per barrel. It's come up a little bit today, but it's still not bad because it's hovering at about 70 to $71 per barrel, which is actually quite a good level for a lot of oil majors to be making quite decent profits out of that kind of price. But yet, the market is not recognizing that. A lot of oil and gas companies are still languishing at very low levels. Construction, I think for good reasons, which I'll probably explain later as I go along. The other sector, which I think is probably a surprise, is plantations. Plantations since the middle of the year have seen CPO prices going north of 4,000 per ton, and for 2 consecutive quarters, right? We had plantations companies reporting earnings which exceeded analyst expectations. But the market doesn't seem to be appreciating that. It's ending this year at a loss of about 12%. So I think, again, one can't help but question whether there is deep value in some of these bombed out sectors, right? Hopefully we find an answer as we go along. Now, this chart on the right is quite interesting because it shows you how much the price to earnings ratio has fallen from 2020 versus 2021. Now, remember I told you that 2020 was obviously a lousy year because that was the start of the pandemic. Everybody was running around, wondering what to do, and then a lot of companies were affected in terms of profit. But 2021 was a year of recovery. CI was up. We're projecting at 108 cents. Is about 40% up from 2020. And if you look at, because of the higher earnings and price not really moving, keeping pace with earnings, the PE of many sectors have fallen. Now, the ones that have fallen the most, for example, plantations. 2020 was about at the end of 2020 was trading just below 30 times, and currently it's now trading at in the low teens. Industrial product, earnings have ballooned. I mean, press metal, for example, Malaysian smelting, and a handful of tech companies in that space also have reported very good earnings. PE has fallen. Property has fallen a lot. Technology is the only one, I think, that has shown an increase in PEs. But people are still loving that sector and are willing to pay high PE for that. But I mean, generally, what I'm trying to say is that a lot of sectors PEs have been derated, and it seems like one wonders whether there is this. How long is this derating going to last, or will we see a turning point at some point? Hopefully next year. So I think let's pause and think about what went wrong in 2021. What's causing this, sudden, collapse in PE, and why aren't certain sectors price keeping pace with the good news in terms of earnings, right? Well, some of the forces that's been working against the market are as follows. I think one of them would be unstable politics. I think we all know that for 2020 as well as part of 2021, we had to deal with changes in government. I think so it was from Pakatan Harapan to Perikatan Nasional, and from Perikatan Nasional to Ismail Sabri's BN alliance. So there was for a period of time there was a hung parliament. People weren't sure whether PM Muhyiddin would hang on, and for how long. So these things were things that kind of like held back foreigners from investing in Malaysia. So they were only in the bond markets, but they just didn't dare come in a big way in equity markets. So that was one of the culprits, I believe, that held back the market both in 2020 and 2021. The other one, of course, was no one imagined that COVID-19 would have had such a lasting impact. We thought it would be a 1-year affair, but we're now at the end of 2021, and we're still seeing the advent of new variants of concerns and so forth. So yes, COVID-19 has escalated. At one point, it was we were generating something like 22,000 cases a day, which was very unsettling, and lockdowns had to be extended, and therefore we had to cut earnings forecasts, GDP growth forecasts, and so forth. I think the third one was ESG. ESG has become a real bugbear. It didn't help that at this point in time, fund managers, especially large institutions, are becoming more ESG sensitive. I think in a way, it's long term, it's for the good of everyone. But it came at a time when our sectors like gloves, plantations, even certain companies in the tech space were accused of mismanaging foreign labor, and as a result, there was a huge sell down in some of these names. And even Kenanga at one point was sold down because he was kind of accused for using too much coal-fired generators, and so they were sort of punished by some large foreign institutions selling down the stock. So these ESG things are actually very, very negative for Malaysia, because I think it's time that Malaysian companies get their act together in terms of improving their ESG standards. So I think that's being addressed. The fourth negative part was property tax, prosperity tax, which penalizes large profitable companies. I guess it was also done because the government needed some form of added income to try and close the gap because of the high fiscal debt that they're facing at the moment. Stamp duty increase was a negative. The government in the budget 2022 announced that they were going to increase stamp duty from 0.1% to 0.15%. That may not be that bad, but they removed the ceiling of $200, and that would have a big impact on trading activity, because for large trades, suddenly you find that what you used to pay just $200 for large trades, you're going to pay 0.15%. So it became a linearly increase in transaction costs. Now that's going to cost, unsurprisingly, higher transaction costs and deter day traders, for example, who they make very small daily margins as return. So if you got to pay stamp duties of 0.15%, that could eat into your daily returns, and there's less incentive to trade actively, right? So that's a negative. Rubber gloves at one point was a very big component of the CI, and because ASP came off sharply, and they've been disappointing in terms of earnings delivery from quarter after quarter, so that was a really big negative hit on the CI. And lastly, 2020 and 2021 were very trying years for the rakyat. A lot of people suffered in terms of loss of jobs because of the pandemic, and the government has tried to help by allowing withdrawals. So you had schemes like iSinar, iLestari, lower the monthly contribution to savings in the EPF. So for a time, what EPF used to enjoy fantastic inflows year in, year out, and I think I won't be wrong by saying that this year they actually, for the first time ever, saw a negative outflow of funds. And then, as you know, EPF is a big source of liquidity for the stock market. So that just reversed this year. But fortunately, there is a lot of liquidity in the system, and it helped a lot that. Fortunately for us, in 2020 and much of 2021, foreign inflows into the bond market was actually very strong. Recall that in the early part of this year, FTSE Russell reinstated Malaysia into the World Government Bond Index. That helped to bring in quite a bit of money, foreign money, into the bond market. So that helped, in terms of maintaining the high liquidity in the market. Otherwise, it would have been quite bad actually. So yeah, things went wrong, but it could be worse. Now, what can we look forward to in 2022? Would there be a U-turn on stamp duty ruling? I heard from reliable sources that a lot of investment banks are lobbying the government to reconsider the increase in stamp duties and removal of the cap. Let's hope the lobby will works and a compromise is reached. And another very important event to watch out for will obviously be the general election. My guess is that it's going to happen next year. I bet my bottom dollar it's going to happen next year. It's a question of which month, I suppose, but we'll dwell into that a bit later. I think I'll demonstrate afterwards why there is very low expectations by the market for the fourth quarter earnings, which is going to be announced in February. So I think I think it's good that there's very little expectations in terms of that quarter's earnings, so that hopefully it won't end up with a disappointment. Now, inflation is something to look at because it's been much of a concern for much of this year. But my guess is that inflation is going to peak probably around the middle of 2022, and hopefully that will lessen the central bank's urgency to raise rates. I think the central bank will raise rates, right, when the economy recovers, the recovery takes hold. At the moment, it's still a bit tenuous because of, to borrow a term that Bank Negara use, they are concerned about downside risks due to new variants of concern. So at the moment, they're holding back tightening, although inflation seems to be, rising. But my sense is that inflation is likely to peak probably in the middle of next year. So that would help, I suppose, to support the market. And money supply is going to be strong. It has been strong since loosening of monetary policy last year. Money supply is still strong. Liquidity will remain high, at least in the first 9 months of next year, if not beyond. That's our base case, yeah. And finally, because the Fed has started this taper program, it's going to raise interest rates next year. Expect the USD to remain a strong currency, and that will obviously benefit our exporters. Now, let's talk about, let's try and guess the timing of general elections. Now, the reason why I say general elections will likely be called next month is, I suppose, it's quite obvious to many of us. We had two recent state elections. In Malacca, you've seen how convincingly the BN side has won the state assembly. Yeah, I think they won by more than 2/3 majority. And over the weekend, GPS, amazing. They garnered something like 93% of the state assembly. It was 76 seats out of 82. And as you all know, GPS is an ally of the BN. And it looks quite clear that the opposition, the biggest opposition alliance, which is Pakatan Harapan, is in disarray. DAP only won 2 seats, PKR none, Amanah none, and the other party PAS also 1-0. So with that kind of prognosis, right, I think it's only fair to assume that the current coalition, ruling coalition will try and hold elections as soon as possible. Now, if you look at the number of elections, right, held in the past in terms of the months they were held, this is since 1959. We had 3 elections in the past that was held in April, 3 in May, and 3 in August, and then none in January, February, June, September, or December, and very few in July, October, and November. Fourth quarter is a very bad time to have elections because of the flooding and monsoon in the East Coast. So I think it's down to whether it's going to be held in May or August. April, and as we know, April is Ramadan next year, and Raya is in the early part of May, right? So one would guess that probably late May would be a time, would be a window or June even for the government to hold elections. Feeling which I suppose August could be the other possibility. Now, if you recall, the government the current government has actually agreed. There was a memorandum of understanding with Pakatan Harapan that they will not hold the GE before July next year. So assuming that they honor that commitment, then obviously it's going to be in August, I think. But if they break that promise, then it's going to be in May. My bet is probably going to be in May. That's a part of elections. Yeah, I think it's going to happen. It's either May or August. And the other thing is that I mentioned earlier on that fourth quarter earnings has very low expectations. We had 3 quarters of earnings released so far, and I told you earlier on that the street is expecting, along with us, about 108 cents per share. So the implied fourth quarter EPS is even below third quarters. So not expecting much. So hopefully there won't be disappointments in terms of fourth quarter earnings delivery. I know of late there have been queries about whether there's downside risks to fourth quarter earnings because of the flood in several major states in Malaysia. It is an unfortunate calamity. I'm sorry if there's anyone amongst us who's been badly affected by the flood. But our view is that yes, there might be some impact on earnings and even growth, but I think it's going to be not really that material. I think the important point is that 2021 is almost over, and I think a lot of if fund managers will be looking towards 2022 and beyond to value where the market might be headed. So unfortunate as it is, this flood impact is going to be a one-off, and it's going to affect 2020 fourth quarter. But as I say, even before the floods, right? The analysts have low expectations in terms of earnings delivery in fourth quarter. Maybe they've been a bit too cautious or conservative in their assumptions about the lockdowns being prolonged beyond October, but it was lifted in October. Long and short, what I'm trying to say is that hopefully, even with the impact of the flood, there won't be much disappointment in terms of fourth quarter's earnings delivery. Why do I say that inflation is probably going to peak in the middle of next year? Well, already we're seeing that certain leading indicators of inflation, such as the Baltic Dry Index, which is a kind of like proxy for freight charges for transporting basically bulky dry goods, right? The BDIY has been rolling over. This is the light blue line at the bottom here. You can see that it peaked around September, and it's come up quite a bit. Just indicating that perhaps there's some loosening or easing of tightness in the supply chain disruption that we've had much of this year. And also the freight management index also has been rolling over. Oil, that went to as high as 80, 85 in recent weeks, have come back down. Today is about $70 to $71. So these things are showing a bit of moderation in prices. So hopefully that will translate to more moderate increases in prices of consumption goods and so forth. Now, liquidity is, I believe that liquidity is going to remain very, very strong in the first half of 2022. As I say, if the central bank is going to raise rates, tighten, monetary policy, it's going to be probably in the second half, and certainly after elections. Yeah. So I think for the first half of next year, the coast is clear in terms of high liquidity staying in the system, and this liquidity is being facilitated by the fact that OPR will remain low. It's going to be, we believe the OPR will remain at 1.75% for much of next year. Probably it's going to be raised, if anything, earliest would be third quarter of next year. SRR, statutory reserve requirement, is at 2% now. It was reduced from something like 4% early part of last year down to 2%. And it's actually lower than 2% because it's effectively zero, because the central bank allows the banks to use the reserve money to buy government bonds, MGS or GII, and count that as reserves. So therefore, it's as good as bringing down SRR down to zero. So there's a lot of money that is in the system, right? Okay, I think the next chart is interesting because the brown line here is the ratio of M2 money supply over the market cap of the Malaysian stock market, and the blue line is the KLCI. Now, M2 money supply over market cap, that ratio stands at about 1.2 times today, right? And the CI is about 1500. Now, the last time the CI was at 1500, right, was around, I mean, the pandemic low in March aside, I'm not counting that part. The last time the CI was around 1500 was about 2011, around here. At that point in time, M2 over market cap was less than 1, was only about 0.9. Today, for the same level of the CI, you have a lot more money sloshing in the system because M2 over market cap is 1.2. So what I'm trying to say is that a lot of this money is now not being put to work to drive the stock market up. The potential is there. It's just that the confidence, for whatever reason, maybe also all the negative factors I mentioned, the ESG, the political issues, fear of inflation, and so forth, are causing the people to stay at the sidelines. I believe that a lot of institutional funds have money in the sidelines. They've been selling for most part of this year. Foreigners also have been selling, except for the last kind of like 4 months for a brief period they were in, but a lot of them have been selling. So there's a lot of money in the sidelines, right? That's not being put into the market. Okay, but not everything is hunky-dory. I've given you some positive factors that might work in 2022, but what are the investment risks? Let's have a more balanced view on and be realistic. GE15 to some is a risk, but for me, there can only be upside risks. I think it's quite obvious that the outcome of GE15 is going to be a decisive one. I don't think it's going to end up in a close fight. I think it's going to be a decisive one, and in a way that's good for the market, because the market wants certainty and stability. Yeah. So that could be a positive. Instead of a negative risk, it could be an upside risk. Omicron, yes, there's an upside chance the variants could threaten again. We are not saying that we're out of the woods yet in terms of COVID-19. I think it's still a threat. But what we're saying is that it's a threat that we're becoming increasingly familiar with. It's something that we can deal with better compared to 2020. So there could be a lockdown reoccurring again because of Omicron, but I think it's something that it's going to be a situation where we're more prepared, and therefore maybe the scale of the impact on economic activities will be much less. On this matter, I think it's important to see. Omicron is actually very pervasive now in the UK, and I think over the next few weeks or so, I think let's keep an eye on the number of deaths, death rates in the UK. Omicron has caused a surge in the number of daily cases, but what about the deaths? If the deaths rate are stable or even declining, that's good news, because it shows that Omicron is a very transmissible, very contagious variant, but maybe the vaccinations and also probably natural immunity that we've developed are able to withstand this new variant better. And so while it's more transmissive, it's less lethal. I think if that's the observation that people see, then they might be less afraid, and therefore there will not be severe lockdowns. Right? Let's monitor some of these statistics as we go along. But I think let's not be overly pessimistic about COVID-19. I think there is reason to be hopeful that 2022, while we're going to still be living with the virus, I think we'll be able to kind of handle it in a much better way and minimize the impact on our livelihoods. Labor mismanagement and issues exposed is an investment risk. Again, I think it helps that it's a year-old issue now. For example, I think Top Glove has come out of this quite well. I mean, they've got themselves reinstated by the CBP to resume exports of their gloves to the US, and I think it's great. Hopefully we'll see Sime plantations also, getting their act together and also get back to the good books of the CBP. And I think while this can be a risk, but I think we're dealing with it, and hopefully we get better as we go along. And that goes also to applies to the tech companies who've been probably fallen short in terms of the way they manage the labor. Oh yes, this one is very important. I think we're going to be very vigilant that there could be a very sharp stock market correction in the US. That I would rate it quite an even chance that it's going to happen in 2022. I'll probably explain it as I go along. So if there's a big risk to our market, it's going to be external from the US. Runaway inflation is a low probability because of I think the Fed is starting to tighten policy, and that would have the effect of raising effective rates, and therefore have put a lid on prices. And also, when the lockdown eases, right, congestions at the ports, for example, the transport links is going to be eased, and that will help to alleviate some of these supply constrictions that has caused prices to go up. So hopefully, as lockdown eases, with US tightening rates, inflation can be contained. So runaway inflation, I think, is a very low probability. BNM, the central bank, will finally tighten monetary policy. Now that's something to be watchful for as well. But I think it's going to likely happen only in the fourth quarter of this year, because when SRR rates are raised, OPR is going to be raised. That's going to withdraw liquidity from the system, and that's not good for the stock market. I think fiscal consolidation is going to happen because the government's balance sheet is very stretched. They can't go on expanding, spending the way they did over the last 2 years, 3 years, right? Consolidation has to happen at some point. I think it's going to happen after G15, probably 2023. I think we're going to worry about things like GST being reimposed again and things like that. And the last risk would be FOMC tightening. As we all know, when interest rates in the US goes up, it does tend to reverse the fund flows into not just Malaysia, but just emerging markets in general. So, you know, the bond market has been enjoying inflows from foreign bond managers, but I think that those days could be counted already. Okay, why do I say that there's a big risk that the stock market in the US is going to correct? Now, if you look at the SPX, the S&P 500, right, you realize that it's trading at a PE of about close to 24 times. Its 10-year mean is only 15.9 times. It's trading at almost 2 standard deviation above its 10-year mean. And so far this year, if you look at corrections in the Dow or even S&P, there hasn't been more than 5% correction each time it falls. The ascent in the S&P 500 has been tremendous. Not just this year, but last year, the year before. I think over the last 3 years, the S&P has been delivering something like 18% returns every year. It's just so amazing. I think it's becoming quite expensive. Okay, what I'm going to share with you is not something that comes from me. I just want to share with you an observation that's been pointed out by a few global strategists that I've been doing some research on. And they look at the bond yields, right? And throughout the course of the last kind of like 3 to 4 months, since the Fed alluded that it's going to start to taper and raise interest rates, you saw that instead of the long end going up in terms of the yields, it actually came down. And what we saw was increasingly the US bond market, the US Treasuries yield have been flattening as the Fed guides as to the timing of the rates increase. So bond yields have been flattening, and it's approaching what we call an inversion situation. An inversion means that the long end yields converges with the mid and the shorter end. You get basically a flat yield curve. Now that's a very dangerous signal, because it's actually a leading indicator of heightened expectation of a recession within a year or two. In the past, right, if you look at this chart here, every time a yield curve inversion takes place, there's a massive correction in the S&P 500. No exception. This happened in '89, at the turn of the century, 2007, and 2019. early part of 2019. Huge, massive corrections. And I think the next one is about time it happens, sometime in 2022. I don't go to the mechanics of why this is, but generally it reflects the concern that as the Fed raises interest rates, there is a risk that they over tighten, such that the real rates become too high, right? And when real rates become too high, that would make cost of capital expensive, and that will have the tendency of bringing down present values of risk assets. And that's the logic behind why an inverted yield curve causes the major correction. Now, the chart on the right, what I'm trying to project here is that Malaysia will not escape from a major correction in the US, because the S&P 500 and KLCI is correlated in terms of returns. So I did this data analysis over the last 3 years, 2019 to 2021. Yeah, 3 years of data, and it shows convincingly that there is a correlation between S&P 500 weekly returns and KLCI's weekly returns, and the correlation is about 50%. 0% would mean there's no correlation at all. There's just random movements on each variable. But here 50%, that it shows that there is some kind of connection between the movement of the two markets. So we are connected in a way. So if S&P 500 falls sharply, tendency will be we will also fall very sharply. So something to be aware of. Yeah. Okay. To address another concern, I've been hearing that people are afraid that because of the taper, Fed is raising rates, foreign outflows will cause liquidity to dry up in Malaysia. Not really that bad a case. Okay, firstly, let's put things in perspective. Malaysian bond market since 2020 has enjoyed quite a good run in terms of inflows into the bond market. Of late, there have been some months where we saw foreigners withdrawing money from the bond market. Maybe it's because of the taper, increasing the guidance by the Fed that they're going to raise rates and things like that. So there was some you're beginning to see some trickling out of the bond market by foreigners. In terms of the equity market, we've had negative, we've had outflows for so many months over the last 4 years or so. The last time we had inflow was, I think, in 2017. But since 2018, we had most months are negative, and I think it's fair to expect that it's going to continue to be negative. But as I say, domestic liquidity can absorb. Is still very strong, and I think it can absorb this potential outflow. And okay, one of the reasons is because not only has M1, M2, and M3 been increasing, money supply is also one of the sources of money supply. It's not just the releasing of the reserve money into the system by lowering SRR, but when the economy picks up, when there's more economic activity, the money revolves around the monetary system, right? As you know, the banking system goes in and out of the banking system. That circulation of money or velocity of money can bring about increase in money supply. As the economy picks up, we're going to see more and more of that money circulation generating more supply. So that hasn't happened yet. Number two, EPF contribution. This year, we saw net outflows from the EPF. But next year, right, when jobs gets restored, I Sari ICNA, the withdrawals have ceased, right? The pension fund will receive inflows of money, so that will be put to work into the bond markets as well as the equity markets. So there are offsetting forces that could absorb the potential outflow of foreign money. So just to allay some fears that the outflow of foreign funds is going to cause weakness in the market, not necessarily so. And it also helps that the percentage of foreign ownership in Malaysia's stock market is actually very, very low at the moment. As I say, there's been outflow of funds since 2018. For 4 years, you had outflow of funds. So, it's not going to there's very, very little left actually to in terms of further flows out of the equity market. I won't dwell in this chart for much. It basically, reflects what I've just said, that EPF contribution is going to normalize, because of the ending of all these withdrawal schemes. Velocity of money is going to pick up as the economy recovers, and therefore it helps to fund more money supply. And okay, let me turn to the 4 themes that we think might work well for the market for next year. The first is the economy reopening. I think quickly, I just want to share with you some positive statistics with regards to the COVID cases, and the fact that I think it's fair to say that the pandemic is under control. If you look at the number of daily cases reported per day, it's come down to, it used to be, at its peak was about 25,000 thereabouts, and now it's down to less than 4,000 a day. It's heartening to know that 97% of adults in this country are fully vaccinated. In terms of the adolescents, by that I mean those between 12 to 17 years old, 87% of the adolescents are fully vaccinated. So quite a large number of us are actually, at least to some extent, protected from infections. And also, active cases have come down sharply, below 100,000 for many months. And also, positivity rates, the rate of those being tested positive, has also come down quite a lot, below the threshold of the WHO. So these are very positive signposts that at least I think we have gotten our act together for now, at least. So I think it kind of gave us a bit more confidence to say that the economy is reopening, and tourism spending, interstate travel, international travel will soon resume. Actually, local travel has restarted. And I think some of the players that will benefit from this reopening plays would be the likes of GHL, which is an e-payment operator. GHL would benefit from more on-site payments, because as people shop on-site, they'll be using credit cards. And on-site payments are where GHL enjoys the highest merchant discount rates. So the income would be more compared. So the mix of payments is now growing in favor of on-site versus the online payments. Online payments, they actually earn less compared to on-site payments. So generally, with greater spending, that will also help to increase the revenue for GHL. I think the other thing to note about GHL is that it's enjoying a kind of a growing behavior in terms of payments, from people using cash to pay into sort of e-payments. I think especially among the younger generation. They prefer to use e-wallets and contact payments. And right now, so much so because people are afraid of getting their hands into what might be a COVID tainted device or something. So they, there's this propensity towards using contactless payments. So all these kind of developments helps the likes of GHL. REITs, especially those with exposure to malls, have suffered so much in 2020 and 2021. Hopefully, with more malls opening, footfall traffic coming back, the days when rental rebates are being given would be over. So income would be more normal. So that's a potential. And REITs haven't recovered back to pre-pandemic levels yet. The second theme would be emergence of value. As I said, I've spent quite a bit of time arguing that a lot of sectors are well below pre-pandemic levels. Some are still below, even though earnings have recovered in a big way. We are lagging our ASEAN peers. PEs have derated. So I think value is something that's emerging. And where are they? Well, I think oil and gas is one sector where there's a lot of value. If you look at the behavior of the sector in terms of its returns versus the price of Brent oil, there is a disconnect because since the end of 2020, the end of the first quarter this year, we saw that the sector's prices kept falling despite the fact that Brent recovered all the way above $80 per barrel. This is quite unusual because in the past there's always a positive correlation, but there's a disconnect this time around. And oil and gas, it could be that also because of the lockdowns, some of these oil and gas players couldn't produce in the normal capacity that they could have because of curtailed deployment of workers, and output was low as a result. But as lockdown eases, some of these activities could be normalized, and hopefully that will translate to earnings that are higher, at least closer to pre-COVID levels. So I think oil and gas is where you can find a lot of value. The third theme would be the search for yields. Well, when I look at what banks are offering in terms of FDs, it's pretty sad. You're getting hardly 2% a year. If you're lucky for your FD. So that drives investors to look elsewhere for yields, stock market. And I think FDs rates are not going to go up anytime soon because LDRs, loan deposit ratios in the banks are low by historical standards. The liquidity coverage ratio is still high, and they're not competing for deposits. So ample liquidity, low interest rates makes people continue to search for yields. So so where do you find yields? Well, you can find them in REITs and certain consumer stocks and even gaming stocks for those who can buy gaming stocks, right? I'd like to share with you that BJ Toto is one that gives you fantastic yields, and it's been sold down aggressively. I think there's very little downside in terms of price for BToto, and it gives you a very safe yield of nearly 7%. The last theme, the fourth one, would be strong US dollar, because as I said before, rising rates in states in the US would tend to give rise to a strong dollar, and it improves the pricing power in local currency for our exporters. So we like the tech players. I think rubber gloves also. For those who can wait, who are not in a hurry to realize returns, I think rubber gloves would be a beneficiary of this particular theme. Plastic packaging manufacturers, oil and gas, and plantations as well. In this space, we like KGB, Kellington, and Inari. These are the two top names in the technology space. And the sector recommendations we have for the first quarter of next year would be the following. We like building materials. Here it's being anchored by press metal. We still like press metal because we think aluminum prices will remain quite high for much of 2022. There's also new capacity that's being deployed in press metal that will enable earnings to keep growing for the next 2 years. Gaming, it's a economy reopening play. I think Genting, BJ Toto, media, when jobs return, and economic activity recovers, there'll be more advertising spent. Astro will have probably subscribers coming back, for example. So I think we like media. In a way, it's also part of the consumer play. REITs, I've spoken enough. Oil and gas, technology, and utilities. These are the sectors that we have overweights on. And just to share the last slide with you, I think we're running out of time. 9:45 already. These are the 10 names that we like. I think in a recovering economy, you can't do without banks. The two banks we like are Alliance and RHB Bank. These two banks actually give you very nice yields. Alliance Bank give you nearly 5% yield, and nearly 6% for RHB Bank. Between the two, Alliance is a more risky bet, in the sense that it's got great exposure to SMEs. But we think that in an environment where the economy is recovering, you could get a big upside from the SME portfolios, because when SMEs are doing well, then hopefully the credit costs can improve, and that will have a big swing for Alliance Bank's earnings. And as it is, they've been reporting earnings has exceeded expectations over the last quarter, and it seems the momentum is quite encouraging for Alliance Bank. RHB Bank is got capital safety. We are confident that they'll be able to pay dividends. Its big shareholders are EPF and OSK. These are dividend. These are major shareholders who demand dividends from them. And there's a near-term catalyst. I think probably early part of next year, we're going to see whether they might be awarded the digital banking license, which they have jointly bidded with Boost. So chances are, we think that they stand a good chance of getting that. So if that happens, then it could be a catalyst for RHB Bank. Axis REIT is our top REIT pick. It's not a mall. It's not exposed to mall, but it's got a very good portfolio of industrial properties and warehouses. Warehouses is actually in high demand at the moment. And it's proven itself to be very resilient. Even in 2020, when at the depths of the pandemic scare, right, it was able to deliver earnings growth. There was very little in terms of rental rebates that troubled Axis REIT. So they did very well actually, and they give you a yield of nearly 5%. BJ Toto is a bombed up stock. It's only 188. We have a target price of 223. It gives you a dividend yield of 6%. And my colleague analyst Tay, he's built in a very conservative assumption in terms of recovery in NFO sales. In fact, he's not assuming that even in 2023 they're going to be able to achieve pre-COVID level sales. So then we have Dialogue. Genting is very cheap, because let's not look at price to earnings, because earnings are pretty hard to pinpoint, but on a price to book ratio, it is trading at 1 standard deviation below 10-year mean, so it's cheap. F&N is a steal. I think it's a household name for a company that has net cash, is able to deliver an ROE of 14%. That's quite amazing. Prudent management. Is trading at a PE of 20 times, which is 2 standard deviation below 10-year mean. It's very cheap. and this year is down 20%. I think it's undeservedly being sold down. GHL I've spoken. KGB is going to have another good year. It's been able to amazingly win a lot of jobs this year. I think the order book is has exceeded 1 billion. They are a beneficiary of chip shortage, semiconductor shortage. They've clinched a couple of jobs from wafer foundries in Singapore as well as in Sarawak. And with 1 billion job in hand, they could last them for 2 years in terms of keeping them busy. So, and yeah, we've got a 47, we've got a target price of 250, which gives 47% upside. MIC, go for the yields, 5%, is backed by very steady cash flow from the LNG assets, LNG carriers, yeah, safe. So yeah, that's it. The 10 names which we like, and yeah, that ends my presentation. I hope I haven't taken too long.
All right.
Yeah.
All right. Thank you,
yeah.
Mr. Koh, for the very impactful sharing on this. I think a lot of us have got a lot of value out of this. And then even one of our attendees asked, it's very informative and useful for us. Do Kenanga publish the market outlook for 2022 for public? If yes, where could we get the report?
It'll be out in a few weeks' time now. Yeah, actually, you have the privilege of hearing. This is actually like a sneak peek into what I'm going to write. So I'm sharing with you early, actually. Yeah, but do be patient. Another couple of weeks, it'll be out.
Okay, where can we get that?
I believe we post it in our website as well as I think Jason might be able to tell us how our clients can access our reports. I believe it's posted in our Kenanga website.
You will be available in CanTrade as well.
Yeah,
right.
CanTrade, that's right.
So if you're a client, then you can have access to the report. Yeah. Okay, so there are a lot of questions on the panel already. So the first question, let's do the one by Jason Lee. Okay, can you share with us when will you be willing to re-rate PE of a stock? What factors come into play?
Right. Yeah, that's a good question. I also asked myself, we've been derated over the last 12 months, what will it take to get us back into premium valuation, or at least on par with the past, or even with our peers? That's a very good question. I think policy is important. I think the regulators, politics have to play their part. I can't help but feel that for much of 2020 and 2021, politics have been quite a bugbear, so to speak. They caused markets to derate because of the instability, and that caused at least the foreigners to stay away. So if something can be done on having a more stable government, and a government that does the right things, implement the right policies, that would be very helpful. I think budget 22 could have been better. I think I remember in the third quarter, I think the market was recovering until the announcement of the budget 22, when several measures were deemed to have been quite negative on the market, especially in terms of prosperity tax, as well as the stamp duty that was imposed on trading. And so that kind of thing doesn't help market ratings. I think we also have to get our act together in terms of ESG management. So hopefully we see better labor management, more concerted efforts towards less carbon economy. So that will help in the long term in terms of giving us a better PE rating as well. So
All right.
yeah, so this is some of it.
Thank you, Mr. Koh, for answering this question. So the next question is by YH Peng. So just now you mentioned you forecast that the GE15 will take place next year. So the question here is, what is the effect of GE15 on the market before and after the GE? How do you foresee the market react?
I think my guess is that heading towards GE15, the market might be sidelined. It tends to be the case, especially in the recent past, since BN lost its two-thirds majority, right? I noticed that in the run-up to elections, there have been some nervousness among market participants. So there tend to be a bit of selling down ahead of dissolution of parliament. And then depending on the outcome, they could come back in or they could sell. I mean, in 2018, obviously, there was a big change and there was uncertainty. People weren't familiar with the new government, so there was a big sell down. Because there was reversal in policies and also the contracts that was awarded by the previous government that was reversed. And I think in 2013, I remember there was nervousness towards the election in May, but after the election, the market went on to chart record highs at the end of that year, because I suppose the outcome was, it wasn't a two-thirds majority outcome, but at least there wasn't a kind of a hung parliament situation, like what we've seen with the Sheraton move. After Sheraton move was quite bad, because there was so the house was evenly split, so we weren't sure how long the Perikatan was able to hold, and then it led to emergency, the imposition of the emergency to keep the government together. So those things were actually very unhealthy. But to answer your question, my guess is that probably towards the election there could be some nervousness, but I would bet that the outcome of this election would be a convincing one, a decisive one. And don't be surprised if the market rallies after that. Yeah.
Okay, thank you so much, Mr. Koh. So the next question is, between oil and gas and renewable energy, so which one is a better one to invest in 2022?
Well, seeing that the oil and gas sector has been sold down so badly, right? I think there is space to invest in fossil fuels. Of course, I think in all things sort of equal, then the renewable energy is more appealing, because that's the source of energy of the future. It is ESG friendly. Again, as I say, it's a source of fuel for the future, and it's going to be the go-to source of energy. So on that basis, obviously, you want to be invested in a fuel that's in growing demand in the future. But don't forget, fossil fuel, at least I think it's still here to stay for the time being. It could be pollutive, may not be good for those non-ESG, those ESG sensitive funds. But there is, I think, a situation where there is a supply tightness in terms of fossil fuel, because of the underinvestment in, for example, shale oil in the US over the last 2 years. There was massive overinvestment 10 years ago. I think between 2010 and 2013, there was massive investments in shale oil that caused a huge increase in supply after that. And then recall that 2013, 2014, prices of oil fell because of that. And then with the consciousness of the environment, and people turn to alternative energy, renewable energy, and less investment went to the traditional oil sources, the fossil fuels, and also because of the overinvestment in shale oil, there was a correction after that. So over the last few years, you saw that cost of capital, so cost of funding for oil, fossil fuels have actually gone up, leading to fewer investments in new fossil fuel fields. So because of that, the supply of fossil fuels was actually curtailed, and that was worsened by the fact that in 2020 oil price plummeted. That also caused underinvestment in new oil supply. So we come to a situation where demand suddenly surged because of economy reopening, and also coupled with the fact that OPEC and its friends are actually controlling supply of oil. That I think the market is now more balanced, and with the current situation, I think you could see oil remaining. I'm talking about Brent here, probably holding above $70 over the next 6 to 12 months. So on that basis, I think it's going to encourage more activity coming back to the oil and gas space. I think locally, right, I think there is a possibility, I got a feeling, that Petronas might ramp up the capex spending, because if you look at what they have spent so far, this is up to the third quarter of this year, up to October, September, they've only spent half of what they say they were going to spend. 40 billion is a year is what they're going to spend, but they only spent 20 billion. That could be partly also because of the poor oil prices in the past, last year and early this year. Now with oil prices getting better, and also, with the economy recovering, Petronas could increase its capex over the next 12 months or so, and that would be very good for some of the oil and gas listed plays in Malaysia.
Okay, thank you, Mr. Koh. Let's do one last question here, because now we are really overshoot for quite a bit already. So just now you talk about Inari briefly. So the question is, would Inari earnings be impacted badly since Apple is have inventory adjustment for iPhone?
No, I don't think so. I think Inari would be a beneficiary of semiconductor shortage. There is a 5G evolution going on. Smartphones are now getting better. They've got RF chips that are more sophisticated, compact, and Inari is in that supply chain. It provides the radio frequency for the likes of the new Apple phones, and also for other 5G infrastructures that Inari can supply to. I think this issue with Apple could be a temporary one. As you know, we all are aware that there is a semiconductor chip shortage around the world, and I think the supply chain players are now trying to address that issue. I think it's only a matter of time when the supply can be normalized. I think that the amazing thing is that despite chip shortage, right, you're seeing that many of these tech companies are reporting record quarterly earnings. Can you imagine if there's no shortage of chips? If the all these constrictions are eased, I mean the earnings will balloon.
That's right. All right, so thank you, Mr. Koh, for doing this very robust Q&A session with us. So thank you so much once again. All right, so let me go ahead and share my screen. Okay, so for those of you who haven't had a Kenanga share trading account, you may head over to this link, www.kentrade.com.my/. open dash account dash form. So that's how you can fill in your interest so that, the friendly dealer representative from Kenanga Investment Bank will be arranged to cater to your account opening request. So if you wish to open an account with Kenanga, please fill up this online form whereby we will reach out to you shortly. Yeah. So thank you everybody for joining this session. So we hope that you have gained enormous value out of this. So once again, I put in the link here for you to open a trading account with Kenanga. So this is the last session for the Can Trade webinar in 2021. But don't worry, we have more in store for you in 2022. So stay tuned on the Kenanga platform. All right. So thank you everybody and have a blessed Christmas period. All right. And have a blast in your year end. Thanks, Mr. Koh. Thanks, everybody.
Thank you. Thanks, Shane. Thanks, everyone.
Yeah.
Thank you.
Bye.
Bye-bye. Take care. Right.